I've developed something called UFOs. That is where my entries and exits are going to be. Did you knew this was going to happen before you took the trade? No. If you are doing it out of hope, dangerous. I'm a confident guy, but the market also taught me not to be arrogant. As a futures trader, what you really care about is...
This is my journey to go into the realm of futures trading. As you all know, I came from a stock investing background, but very often people talk about making money from futures investment. And with the help of Affin Hwang Investment Bank, I'm actually honored to be able to invite our guest for today, Jose Blasco, who is a professional trader himself. So welcome to the show, Jose.
Thank you so much. It's such a pleasure to be here.
Yeah, first of all, could you introduce yourself?
I trade since 2008. My preference when it comes to trading is what I call derivatives. Derivatives is basically options and futures. Today we are talking about futures. And basically the beauty of derivatives, as I'm sure we'll discuss during our conversation, which is what caught my passion, if you wish, is the fact that you are focusing on something real, for example, gold or oil, but you are trading it, you are exposed to it without owning it. You are using that derivative contract to get exposure to those assets. And that's something that I felt very cool in my early stages, and that's what I do. So
apart from that, I understand that you also wrote a few books. I think it's called Mastery to Mastery series book.
Yeah.
Could you just share a little bit about what are those books about?
Yeah, well, it's about trading. It's about learning trading the right way. And the right way, again, I'm sure we're going to touch on many of those concepts during our conversation because you cannot talk about trading touching on key concepts. The key on one area I saw that was not properly covered out there is that many books about trading, they would teach methodologies, which obviously you cannot trade without a methodology, but there are other aspects that are even more important, such as risk management of human emotions. And I'm not saying there are not books on trading psychology and things like that, but putting it all together, if you wish, right? So this is the concept of going from this mystery, what is it, this thing about trading, to mastery, where now it becomes effortless, it's muscle memory, and you are doing it the right way. That's the key. Managing your risk, being safe in the marketplace, exposing yourself for potential profits, but on the safe side, because it's not always going to be the case, and you have to be safe when the market goes against you.
The only thing that people know is probably buy low, sell high. But I suppose the key here is to find where is the low and where is the high. Exactly. And don't end up buying high and then you sell low and make a loss out of it, right?
Exactly.
Yeah. Just now you mentioned you're very passionate about futures trading. What motivates you to go into futures trading? I mean, there are stocks traders as well, and people also make money from stocks and all that. But why futures in particular for you?
One first reason that was key for me is the concept of diversification. What do I mean by that? So let's say you are trading stocks, as you said, you trade stocks. So one could say, okay, I buy a stock from that sector, I buy a stock from that other sector, I'm diversified.
Yeah.
And in one hand, it's true, you got some level of diversification in your portfolio by mixing stocks. But the reality is that when you have an economic cycle and the markets overall go up or down, what you typically experience with stocks is that they all tend to move in the same direction, maybe at different speeds. Whereas with futures, now I'm not exposed to stocks. Now I'm exposed to, let's say, gold futures and oil futures and
commodities in general.
Commodities could be even agricultural, corn futures, soybean futures, or equities, currencies, euro futures, or bonds, 10-year note, 30-year bonds. So next thing you know, if you build a portfolio with all those various futures contracts, which are the underlying assets, right? The thing behind the futures contract. So they are a real different thing, like how a bond compares to crude oil. Right? So then you add a level of diversification that goes to the next level. So that was very attractive to me. Apart from other characteristics of futures trading, such as, most of the futures markets will be open 23 hours a day.
Do you even sleep?
Well, here's the thing. The fact that the markets are open many hours a day doesn't mean you don't sleep. To be honest, I may take 1 or 2 trades a day, intraday, and I'm done. But the beauty of having the market open 23 hours a day is that those 1 or 2 trades a day, you can do that anytime it works for you.
So what's your usual trading hours within that 23 hours?
Well, I like volatility. Okay. Obviously, volatility, depending on how we use this word, and some people may be like, wow, volatility is scary. Some people may be like, nice, volatility, depending on how you think about it. I mean, everything in life is a balance, or ideally, you want to find balance in everything you do in life. So to me, there are certain hours during the day where futures markets may be open, but maybe volatility is a bit too low, which may be ideal actually for a new trader learning how to trade futures because the market moves slowly, gives you time to think and so on. But when you have more experience, you do appreciate a little bit more of a spice. It's when US markets open and you can see that volatility start ramping up in a big way.
So to sum things up, while you may diversify your stock investment portfolio into different industry, but ultimately it is still classified as one underlying assets.
Okay.
When you trade into futures, you can go into different kinds of commodities and different kinds of assets as well. You can go into bonds, you can go into commodities, and even come back to stock investment in the sense that you can trade the indices and stuff like that. That's one. And number two is because futures opens 23 hours a day, you can have more flexibility when it comes to when you want to trade your futures. You would look for a time where it has the highest volatility, and then you just trade on that as your advantage.
Correct. Trading is a challenge game, right? You need a plan, you need to manage your psychology, you need to manage your risk. There are many people trading in the world. Those, if you wish, are your competitors, people trade against each other. So, all of this is already in one way, tough enough to then trade a market that maybe is not liquid or a market that trades only 2 hours a day. That would be very, very difficult. So you make your life difficult. So instead, let's put those advantages of futures trading on our side and look for that convenience.
The other thing that I notice about futures trading is that a lot of traders talk about margins. Now, I know the margins in futures has a very different concept than the stock margin that many people are familiar with. Maybe you can share with us what are the differences between these two types of margins?
Yeah, before computer trading, let's say 70s, the 80s, futures traders would need to trade physically on the floor, right? And your broker would be there. And every day you would go, you would take your trades through the broker and you would make money or you will lose money. And if, let's say you buy a contract of gold futures or oil futures, you would have to pay for that, right? And that would be a lot of cash coming out just to get the cash back in at the end of the day because those floor traders, they were active, right? So what happens is that throughout the times, there was a relationship that built between brokers and floor traders, whereas trust, where the broker said, you know what, when you trade futures, you don't need to pay the whole amount every time. What about you just leave me some amount of money as collateral.
Okay.
So if at the end of the day you lost, I'll take the money from that collateral money you leave with me.
Right. It is a very different concept from stocks, because stocks is, yes, you still deposit a collateral, but it is in a form of loan. So based on the collateral, the banks would give you extra money for you to trade whatever things that you like. So in this case, you deposit the collateral with the broker, and then you trade whatever they want to trade. At the end of the day, the settlement comes from this pool of money.
Correct. Typically following the exchange recommendation, they will calculate the margins the margin level. Margin is collateral, it's the same thing. Okay. So when we say I trade on margin, it means that you put X amount of money to be exposed to a market of a greater size, and the X amount of money you put there, that margin money, that collateral money, it's basically representing how volatile the exchange expects that market to be. Because if a market was to be crazy volatile, the broker will be subject or exposed to potential greater risk from their clients. So then they would ask you for more margin. There are times where certain markets become quiet and volatility is low, and then margin rates go down. You may trade a market where, you may need $2,000, $1,000 in your account to be able to trade a market, where that same market, another time, classical example, we talk about the pandemic, for example, where obviously volatility was to the roof. So now exchanges are requesting more, and for you to trade the same market instead of 1,000, maybe you need 3,000, 4,000, 5,000. The beauty is that you just need to come up with that tiny amount of money. You said it perfectly. It's not a loan, so there is no interest payment for that margin. That's a big difference. But the other thing is the quantity of margin you get. If we talk about stocks in the US market, regulation sets maximum margin is 2-to-1. You need to deposit half of the value of the stock you are trading. With futures trading, depending on the contracts and the brokers, so the margin levels could be different, but it's a common thing that you find levels of leverage of 20-to-1, 30-to-1, 50-to-1. Those are things that are out there.
So the trick here is to look for the right broker that is able to maximize the margin so that you're able to trade more contracts. Well,
in one hand, I agree with you because we like efficiency. At the same time, maximizing margin is not really needed because even I would say that because of how it's designed, right? Because futures were traded by professionals, even if you were to pick you know, a broker that is less advantageous, probably you still have plenty of margin. You know, there's plenty of leverage. So it's not needed to go that far in my mind. The other thing that comes to my mind as we're talking about margin is the fact that many people associate margin and leverage as risk and be like, wow, you guys are trading on 20 to 1, on 50 to 1. You guys are crazy. Well, yes and no, depending on how you think about it. If you were to trade with no risk management, with no stop losses, with closing your eyes and let's see what happens, of course that's crazy to trade on 50 to 1. But if you are dealing with a market that trades 23 hours a day and you have stops every single trade you take, even if you trade with a very high level of margin and the market moves against you, you will be stopped out and collect the loss you were expecting to collect.
Right.
That was pre-calculated before the trade. Whereas if we go back to stock trading, and again, nothing wrong with stock trading. To be honest, you know, you have so many opportunities with stocks which are absolutely unique. But normally, going back to the US, you are talking about a market that trades 6.5 hours a day. So you may place a stop, and next day you may have a gap against you. So when you get filled at a worse price because you get all the gap, impacting you negatively. Right. That doesn't happen with futures as long as you trade intraday.
Just to explain that a little bit further, in stock trading, because it only opens from, let's say, 9:30 p.m. in Malaysia time up to 4 a.m. the next morning. And then you would need to wait until the next day, 9:30 p.m. And during this period of time, anything could happen. Anything could happen. And if something adverse happens to the stock that you hold, basically you cannot do anything.
Correct.
Whereas in futures, because the trading hours is 23 hours a day, there's plenty of time for you to make a correct judgment on your trades.
Yeah, correct.
Fantastic. That is something that it didn't come to my mind, right? The other thing about futures is that a lot of people also talk about leverage. Let's say I give you an example on a stock. When you buy one Apple share, it's just one Apple share. But when you go into an oil and gas futures contract, for example, typically it comes in 1,000 barrels per contract. So a lot of people tell me that it is leverage in that sense. You're buying straight into 1,000 barrels of oil. Could you explain that a little bit further, what that means?
Yeah. So the unit when you trade futures is contracts. The unit when you trade stocks is shares.
Yes.
With stocks, you can go as low as one share.
Yeah.
With futures, you can go as low as one contract, but it's thousands of barrels or whatever. It could be ounces of gold, or it could be, X amount of currency if it's, let's say Euro futures, for example. That's packaged, and this is what falls into what's called contract specifications. So when the futures exchanges release and list a futures contract, they set the specifications of that contract. And therefore those contracts have that built in this case, thousands of barrels of oil, right? The reality is that as a futures trader, what you really care about is going to be your tick value or your point value. That's what you care about. You don't care about how much of the oil is per contract. You care about, okay, if the price ticks up or ticks down, how much that pays me or how much that pains me, Okay. That's what you care about. And that's what we call the tick.
Okay, so if a tick is 1 cent, for a 1,000 barrels of oil, that would mean $10 per tick. And one contract up, down would be $10 per tick. Right, okay.
Which a tick in the world of stock trading is 1 cent.
Is 1 cent. Correct.
With crude oil futures is also 1 cent.
Right.
But with other futures markets, it's different. For example, with natural gas, which is another energy product, it would be 0.001. So one more decimal place. 0.001 is 1 tick. So that market moves with a smaller tick size.
Right.
But in the end, what you need to know is how much is 1 tick, which is also $10. In the case of natural gas, because the contract specification is set to produce $10 up, $10 down, depending on the tick movement. So as a futures trader, really, the first time you are about to embark into trading a new futures contract, let's say crude oil futures, you need to do your homework and read those contract specifications and be familiar with it. But the reality is that in your everyday, I don't even remember how many ounces of gold a gold futures contract has. You know what I mean? You kind of forget those numbers. What you never forget is how much is the tick.
How much is the tick?
Because that's what pays you.
Volatility is the word to describe the global markets in 2024. Heightened geopolitical tensions, climate change, and unexpected economic shifts have thrown the markets into a whirlwind, creating uncertainties that left many investors feeling uneasy. However, for seasoned investors, volatility isn't something to fear. It's an opportunity. Because whether there's volatility, there's potential for profit, especially in futures trading. I've mostly been investing in stocks, but with the potential I see in futures trading, I'm eager to dive in. The only thing that's holding me back is my limited knowledge. That's why I turned to Affin Hwang Investment Bank and CME Group, where I connected with industry experts who share invaluable insights. Jose taught me the skills needed to trade oil and gas futures. Elaine revealed her tricks for using a trading journal to learn from past mistakes when trading index futures. And then there's Nanda, the master trader who successfully navigated two major market crises in 1997 and 2008 when trading palm oil and soybean oil futures. Even Peter from Mr. Money TV got curious about futures trading and interviewed Kelvin Ho, the head of derivatives at Affin Hwang Investment Bank. If you're interested in getting started with futures trading like us, check the link in the description to open a trading account with Affin Hwang Investment Bank. By the way, I'll be joining Affin Hwang Investment Bank's event on the 25th of September 2024 at 6 o'clock in the evening, where I'll be moderating a panel with the experts that I've interviewed. We'll be discussing how the upcoming US election could impact the futures market. I know it's a weekday, but light dinner will be served, so don't miss out. Check out the link to sign up now.
The other confusion that I have about futures trading is that when I look at the trading platform, it is not as straightforward as, oh, you're buying a crude oil futures. You have like E-mini crude oil futures, you have like micro futures, you have the normal crude oil futures. So how do I know what product to choose that is the right thing that I want to invest in?
This is a key question, to be honest, because again, we are talking about convenience. Yeah, you know, if you are a good trader but you're trading the wrong asset, you are not at an advantage. So that's a very, very good question. So here's how I like to think about this. The first thing is I like to look at the underlying. Let's talk about the most common traded crude oil, which is the WTI, that stands for West Texas Intermediate crude oil. This is the most common one. The ticker symbol in most platforms is CL. So if you were to chart that, what I like to do is get that chart on a daily time frame and look at an ATR. An ATR which measures the average movement per day of that product. At this time, movement in a day is 1.5, 1.7 points, something like that.
Okay.
So let's say it's 1.5. 1.5 points a day, which is the average movement of crude oil, which changes through time. Again, if you look at this number during the pandemic, it was more because there is more volatility, right? But right now it's 1.5, so more or less. So let's say it's 1.5. Remember, we said one tick is 1 cent. So how many ticks you got in 1.5 points? You got 150 ticks, right? It's 1.5 divided 0.001. That's 150 ticks. And how much is every tick with a standard contract? $10. So potentially, if you are a super trader and you catch the low of the day and you ride it to the high of the day, which we don't do that because you know we try to catch a portion of the day move. But let's say you are that super trader, you go from the low to the high, you would make 1,500, right? So it's 150 ticks times 10.
Right. So 150 ticks is up and down.
Up and down, yes, correct.
Okay.
So now you know crude oil futures has the potential to produce 1,500 a day. What do? You do the same with natural gas. You do the same with Brent oil. You do the same with gasoline futures. You do the same with, assuming you want to trade energy. If you want to trade other futures contracts, you can do the same. And then you end up understanding the potential of profitability per market. And from there, you're in a good place on where to decide which ones to use. Crude oil, WTI crude oil, the CL contract I'm talking about, it's often an easy pick. It's a very nice contract to trade. It's very volatile, but in a healthy manner, but at the same time, it's extremely liquid. So it's a contract that would make happy most traders, I would say, but there are more choices. That's the beauty. There are many choices. So this is one first filtering layer that you could apply to understand what a market may provide as a potential for opportunity. Let's say you decide CL is my pick. I can make 1,500 a day. Right? That's great. But how much am I risking for that potential profit? And maybe that's too much, depending on the contract size of a trader. Right? Or the margin requirement. Maybe they require $5,000 to trade that contract, and maybe in your account you have $3,000. So then it's too big for you, even though it's nice, but it's too big for you. That's when you now move to the micros.
Okay.
The micro futures contracts move at the same speed at the E-mini contracts. The E-mini, even though we use the term E-mini, that's the normal size these days. In the old times, before markets were electronic, the normal size was the full size contract. Full size contract is the one that used to be traded on the pit.
Right. Okay.
It was normally done by professionals only, by what we call the commercials. Okay, maybe all companies. But for traders that trade electronically, typically we go with the E-mini. The E-minis were launched in the 90s, which is 10 times less than the original big size. Funnily enough, because everybody trades the E-minis, the E-minis are actually more liquid than the bigger size. So when I say a futures contract, in my mind, I'm thinking E-mini. Everybody's thinking E-mini because that's the size everybody trades. That's the one that pays you $10 per tick. So what if you, instead of trading the E-mini, you trade the micro E-mini? Well, that's 10 times less than the E-mini.
Oh,
So that means that now every tick will pay you $1.
interesting.
So you need 10 times less margin.
Right.
So now you may be like, okay, so that's the contract I'm going to trade. See if my account is smaller, I go there. Or maybe your account is larger, but you are starting to trade futures for the first time in your life. Okay, so nothing wrong with maybe you do a bit of paper money first, then you go into micro contracts for a while, and then at some point in the future, when you're ready, you go for the E-mini size. Let's say you say, the micro is too small for me because it's 10 times less. Okay, just buy 5. 5 micros is the same as half of an E-mini, right? So you could play with the size to adjust to your risk appetite.
Okay, so a full contract is typically traded by people who really needs the underlying asset. For example, Petronas, who wants to take delivery of the asset, crude oil in this example. And E-mini is typically more for traders to trade, and they would probably prefer cash settlement from what I can understand from you. But now I can appreciate why sometimes in the news people say that, oh, this particular price doesn't really reflect what the market price is, because there are a lot of speculations happening in the futures. So I suppose that's because the E-mini contracts are so active in terms of trading, and the price overshot the fundamental of the full contract. Is that what it means?
If we go back to the origin of futures trading, the reason why futures contracts are called futures is because commercial companies, like Petronas in this case, if we talk about oil, or food companies, if we talk about wheat futures, for example, those companies, they will get into futures positions because they wanted a future delivery of a real physical product, okay, on that future date. They would want it at today's agreed price. So they would sign the contract today, so in the future date, they get the delivery of the product. And of course, they did that in the past, and that's the origin when futures contracts were created, because they wanted the physical thing, because it was needed for their companies or for hedging or whatever. But these days, most of the transactions that take place in futures markets are speculative or hedging in nature. The majority of the trades are not because someone wants the physical delivery, even though they are for sure players that want the physical delivery, but it's not the majority. So speculation is a very big thing. Very, very, very big thing.
Just now you mentioned the word hedging. Now, you also mentioned that typically a crude oil futures contract, you're looking at 1.5 points up, down. So I suppose you have certain kind of strategy to make sure that your trades falls within this 1.5 points. And I believe you do so with some sort of trading strategy around it. Maybe could you share with us how do you do it so that your trade lies within this range?
Trading is all about, there are multiple aspects of trading that are absolutely critical, but one of them, of course, is to have a specific trading methodology that helps you to identify first, are you going to go long or short? What's your outlook? In which direction are you going to trade? Is it even time to trade? So you have to determine that first. And once you have determined it's time to trade, and I decided it's time to go long or it's time to go short, the next step, if you wish, which is the real key step, is going to be setting your entries and your exits. There are a million different schools of thoughts on how to do that. You can talk about technical analysis, fundamental analysis, Fibonacci trading, counter-trend traders using Bollinger Bands, breakout traders using whatever, chart patterns, millions of things, as probably listeners know very well. My approach to trading has a lot to do with the technology I've built myself. So I've developed something called UFOs. That stands for on-field orders.
On-field orders.
Yes.
Okay.
And it's a technology that identifies where potentially you get buy on field orders in the market and where potentially you got sell on field orders in the market. That is where my entries and exits are going to be. If I decided time to go long, I will buy at the price point where I have identified buy on field orders. Not to make it too complicated in this conversation, you may want to think of a buy on field orders, a buy UFO. You may want to think about it as a support. But it's not a support because you saw many turning points in the past, which is where the orders got filled in the past. And now you expect more orders will be filled now, because the reality is that if many orders got filled in the past, the probability of orders to be unfilled in the present is less. So what I'm doing is kind of like reverse engineer that concept. to find areas where you potentially find buy and sell unfilled orders that have not been filled yet. That's the key. So those unfilled orders will create a bounce. I'm going to use the term UFO support, UFO resistance. So you have those UFO support, UFO resistance there, and that's going to be your entries and your exits. From an entry point of view, simple. If you determine the market is in an uptrend, for example, and you want to be a buyer, you will wait for price to come into one of those UFO support and you buy. That's your entry. What about your exit? Well, two things may happen with the exit, because the entry is one thing. You enter or you don't enter. But with the exit, two things may happen. You may be right or wrong. If you're right, you will reach what we call the target. And that's where you exit for your predetermined profit, right? So statistical range of crude oil is 1.5 points. I'm not shooting for 1.5 points as my final target.
Right.
Because
probably 1.2, 1.3 you'll get out, right?
That's a low probability because, again, yes, could you sometimes catch the low of the day? Yes, not every day, obviously not. So there is a lot of competition out there, and it's more practical, it's more pragmatic to go for a portion of the move that's higher probability instead of being a perfectionist, like I used to be when I started in 2008, and try to catch the whole thing, because that when happens, it makes you very happy, but it's going to happen much less often compared to catching a portion of the move only. That's going to be more consistent. UFO support is my entry, then the UFO resistance will be my exit, whatever that is. If this is 10 ticks away, I'll take it at 10 ticks away. I'm not going to ignore that there is a resistance and expect the price to go through like there is no resistance. That's called hoping. If that day there is more volatility and therefore the trading ranges are wider and my resistance is 20 points away, 20 ticks away, fantastic. I'll be happier that day and I'll take my exit there. But I will respect whatever my analysis suggested instead of hoping for something better than what I have on the screen. So this is one exit, the exit when you're right. But what about the exit when you're wrong? You mentioned the word hedging yourself a moment ago too. So when the market goes against you, you basically have two choices. Stop yourself out.
Or double down.
I would say not a very good idea,
Right.
especially with a very highly leveraged asset. Unless you pre-plan for it and your first entry, let's say you enter with half of your size. So now it's okay to buy more if price goes against you, because now you use the other half of the size and now you have a full size. So if you pre-plan for it, nothing wrong. If you are doing it out of hope, dangerous, very dangerous, especially with a high level of leverage. I would certainly not advise to do it like that. It sounds to me like revenge trading type of thing. I don't know how to put this. Hopefully this doesn't sound wrong. I'm a confident guy, but the market also taught me to not to be arrogant. So when I'm right, and I'm very satisfied. But when I'm wrong, let's be humble. Let's take the loss, keep it small, and plan a new trade, because you've been proven wrong. So if you've been proven wrong, what's the point of staying in a trade, trying to prove yourself that you were not wrong when you have already been proven wrong? You know what I mean?
Right.
So in an early stage of trading, I guess we all fall into this type of mistakes. You know, my background before trading was engineering. So coming from a scientific field where you're used to certainty and stuff, so of course you can fall in denial mode and all those things. But look, with futures trading, you know, you have a high level of leverage, which is many benefits, but also you better be professional and accept whatever is happening. If you're right, you're right. If you're wrong, you're wrong. Get out. That's it.
Right. You have shared with us how you manage your emotions when it comes to trade. But let's say you're really wrong, and you're wrong on the upside. Let's say you entry a contract at a certain level. Your target price is 10 ticks away, you take a profit, but the price continues to go up 50 ticks, 100 ticks, 500 ticks. How do you feel and how do you manage that? Do you then say that, I should have leave it open and then, okay, now why not I just double it so that I can continue to make profit from what I didn't make in the past, my opportunity cost? Or how do you do it? Because this is something that is, I think many people out there is eager to know, and they are always being blinded by their emotions, and then based on that, they just make the wrong trades.
Trading emotions is such a big thing, especially in early stages of a person learning how to trade and trading, or maybe in not so early stages, but when you start really increasing size and you got more size in your trades, trading emotions could be you know, such a big problem. And it's funny because what you just said makes a lot of sense, because it happens to all of us and it happens to everybody, and everybody has been there. But at the same time, if you really think about it, it makes absolute no sense at all, because did you knew this was going to happen before you took the trade? No. And you still got to your target?
Yeah.
and you got your profit, the one you wanted, you planned for, and you got it. So what's the reason to be upset about it? But we do, right, in an early stage. So what happens, I guess, is a matter of maturity, which comes with experience and practice. What you need to do really is to develop this carefree state of mind. Easier to be said than to be done, especially in early stages. That's why I said it's a matter of maturity. You have to practice. It's great that these days to trade futures, we have micro contracts, so you can build into that with a smaller size.
I want to draw your attention to the more fundamental side of things. Let's pick an asset as an example. Let's say oil and gas, right? What are the factors that can affect the price movement of crude oil, for example?
So now we are talking about something a bit sensitive. And the reason why, because it's now we are talking about a certain belief system. Okay, if you interview different people and you ask the same question, you will indeed get different answers.
Correct.
Because the reality is that who knows? Maybe the market moved because the OPEC said something. Maybe the market moved because something happened with the dollar index and oil is priced in dollars. The time when people know certain things also varies. So the time where the OPEC, let's say the OPEC is the reason why the crude oil markets moved. The time when the news come out doesn't reach everybody at the same time. So who added many buy orders in the market, who added many sell orders in the market, which caused a move because of the news. Who was that? Who knows? So you never know everything. So that's why I use the term belief. There are certain people that will believe that that was the OPEC. I'll give you an example, very dramatic one, as a good Spanish person. Okay, let's get serious because, to be honest, I want to talk about something that is not fun to remember. The tsunami in Japan many years ago.
Yes.
Crazy and real news. Many people were dying, complete destruction. That was a bad news, and it was real, and it was not a joke. It was massive. So you would say, okay, so you expect a news like that would move the Japanese yen? And the answer is absolutely yes. But wait a moment, what if the tsunami in Japan happened over the weekend? How many orders got filled over the weekend when the market is closed? None. So how much the crude oil markets or the Japanese yen market would have moved? Not at all. Now, what about on Monday when the market reopens? Of course. Why? Because on Monday, all the order placed out as a consequence of the crazy news, then those orders will get filled. And depending if the buy orders exceed the sell orders or the sell orders exceed the buy orders, now the Japanese yen futures will pick some direction, either up or down. So the same thing happens with less dramatic situations. And sorry to go to such an intense case here, but so I make my point. It's about the order flow. So in the case of crude oil, you may have a very important, relevant news coming from OPEC. Whatever those news are indirect motivators for orders to come in the market. And once those orders get filled, depending if they're buy or sell, and depending on if more buy orders than sell orders or more sell orders than buy orders, then you get the movement. So I meet many people, many professionals, and we kind of agree and disagree on this one in the sense that to them, the way they would phrase it is, all move because of the OPEC. And to me, it's not the OPEC. The OPEC is the indirect reason why orders come in, and then the orders make it move. So again, it's a little bit of a matter of philosophy or belief, if you wish. That's why I say it's a bit delicate. Having said all of that, my style when I expose myself to future markets is short-term intraday. So if my trading style was only based on certain news, like for example, interest rates, right? Normally they're reported once a month. So that means I would have one trade a month. So that is not rich enough for me, right? So what I like to do is just to focus on the intraday timeframes. I'm much more technical than fundamental in my particular style. And what I do like to know is I like to be aware of the certain times where certain news are released, which there are schedules for that, and it's always the same day, same time. And when that news comes out, I like to be in front of my computer. Why? Because when the news comes out, I don't know what the interpretation of the news will be. I don't know who will trade the news. But the moment that heavy trading comes in, price will move. I will identify UFO support and UFO resistances, and I will take trades taking advantage of the news as a extra spice, adding a peak of volatility during a moment in time, which helps accelerate my profit when I'm right or get me stopped out when I'm wrong, which is, I'm fine with both.
Yeah.
So that's my approach when it comes to news. So I don't pay too much attention, but the time when they are released. Because at that time, that's where you may have an extra peak of volatility, which may equal potential for profitability.
But do you come up with an expectation of movement of up and down towards certain news?
I don't.
You
don't. I like to wait for the evidence because I'll give you an example with the stock market, since this is a market you know the best. I mean, have you ever seen an unemployment number in the US markets, which is probably one of the key figures, right? Unemployment number is good and the stock market goes down. Yeah, but what about unemployment number is good, but the stock market goes up? Yeah, and what about unemployment number is bad and market goes down, or employment number is bad and market goes up? So, I mean, it's not about, I don't have the power to move the market. So my interpretation is useless based on my mentality.
Right.
I rather wait for the evidence to see those moves begin to happen. So now I have an evidence of what is being interpreted by players that are larger than me, that have the potential to move the market. And I'm going to try to lean on those potential opportunities as I get some evidence.
Right. No wonder I'm not a good trader. Now, just to give an example, just 3 weeks ago, OPEC announced that they would do a voluntary cut of 2.2 million barrels a day towards the end of the year, right? So the stock investment mindset of mine tells me that if OPEC is going to cut production, supply is going to be lower, that would drive oil price up. But oil price went down to sub $80 before that. So if I were to do that trade, I would have lose money. Did you do any trade during that period of time? And what was your experience?
Well, if you look at a daily time frame of crude oil today, you would see crude oil is quite high actually.
Yes.
But you are absolutely right. After that announcement, it went down severely just to hit a very strong support and then go back up to the moon. I do not trade the daily time frame, so I was not exposed to that particular opportunity, but I did analyze the charts because that's what I do. And maybe it's good, maybe it's not good to have some of those preconceived ideas about trading, because sometimes it biases you. But there is this saying in Wall Street, which is, buy the rumor and sell the news, that kind of thing. So you can reverse it as well.
Right.
And this is kind of this exact case. When OPEC reported that, I mean, it's kind of like everybody expected that. So whatever was traded was already done. And at that time, what really was happening was profit taking. My other issue is, let's say your methodology on how you trade crude oil is based on what OPEC does. And you have a way to predict. Maybe you have plugged so much data for so many years into a machine learning system. You have trained it, and now thanks to AI, you have a predictive system, which is actually pretty cool. And it tells you that, likely if the news is like that, likely you will have a move up or likely you will have a move down. Okay, and let's say you have a system of that sort, which that, by the way, exists, and that gives you an edge. To me, that's not good enough. Why? Because you still need to determine what is your exit in case you're right, and what is your exit in case you're wrong. That determines what's your entry. But what about your exit? Because if you're right on the direction, but you don't take profits far enough, or you take a loss too far, then your reward to risk ratio is going to be penalized. And even though you may be right more often than not, overall, you may lose money with that methodology because you didn't exit at the right time.
I learned so much from you today. But if there are 3 key things to take note of for beginner traders to start dabbling into futures, what would the 3 things be?
I will start with step 0, and then I'll add 3 things. Okay. So step 0 is you gotta be educated. You need to know your stuff. You need to know trading. You need to know methodologies, and you need to know the products that you trade. You need to know those contract specifications, understand the point values, understand the margin requirements. All of this needs to be well understood. If you expose yourself to markets without knowing that, forget about it. That's why I'm calling that step 0. From there, key thing, trading psychology. It applies to stock trading. It applies to all sorts of trading, even more to futures. So if you don't manage your emotions in a proper way, you will get in trouble. And when you decide to do something about it, not only is it too late, it may be you may have got a margin call from your broker. So it's very important that the management of emotions is impeccable. Okay, and doing a mistake here and there will happen too, because we're human. But that's what you want to do. From time to time, a mistake. You don't want to be emotional all the time when you trade. So that's very important. Now, that's step 1. Step 2 is the risk management. What will make you survive in a trading career is how well you manage your risk. If you have a fantastic methodology on how you trade, but when you take losses, they are way too big. When you take profits, they are way too small. While your methodology may be 90% of the times profitable, you lose money because your profits are too small and your loss is too big. So that's bad. But not only that, if you vary contract size, depending on how you feel today, it's like, okay, I just took five winners in a row. I feel like I'm super trader. Today I'm going to trade double the size. And now you take a loss, you just took double the loss. So you need to be consistent with your market exposure. There are techniques on how to do that, such as risking 1% of your account, 2% of your account. And as your account grows, you risk more, but not only because your account grows more. If your account shrinks because you're losing money, you risk less. Why? Because you are proving yourself that you're not doing a good job. So manage the risk against yourself by risking less per trade. So lesser size or more size, depending on the account size. So there are techniques, there are ways on how to position yourself to manage the risk. So managing your emotions together with managing the risk are the two most important components in trading, even more than the methodologies. I mean, I've built and we commercialize through my company the UFO technology, all that stuff, which is amazing. But if you have all of that, but you don't manage your risk and you manage your emotions, just forget about it. And if you manage your emotions and you manage your risk, you can potentially use many other trading methods, including things that you may learn in books that you would think is going to be basic. Maybe even some of the things will work well because you manage your risk and you manage your emotions. So those are typically the two ingredients for traders that people put at the end. It's like, okay, teach me a methodology. Just teach me how to trade. That's what people ask you. And then they are like, okay, the risk one day and managing the emotion. Oh, okay, I'm fine. I don't need to manage my emotions. I'm fine. Well, no. When money's on the line, especially when it's real money, we make mistakes. And sometimes, they are subconscious. So it's problematic. So again, number one, managing the emotions. Number two, managing the risk. And number three, which is your methodology. What I will say about the methodology is this. Backtest it. Backtesting is something that not everybody does it. Maybe because people are eager to start trading, they want to see the money in the market, and just go ahead and backtest your methodology. Take your methodology. I mean, you can use, there are many free platforms these days. Like, for example, I'm just picking a random pick trading view, for example, which is you could subscribe to it, but you can also use their free plan, which is, I would say, good enough. And you can replay the market. You can rewind the market back in time and replay the market and pretend you are trading in those past periods and log your trades. And then
log the success rate.
Log the success rate and then review that after, let's say, 100 samples. And now you know what to expect. And why is that so important? Because this is going to give you such a peace of mind to do number one, which is managing your trading emotions. How are you going to feel if you trade and you don't know what to expect of your results? Let's say you just bought a book. You read the book and you start trading what the book taught you and you have no idea what to expect and you get 3 winners in a row. Now you feel like you are invincible. You get 3 losses in a row. You feel like burning the book. And the reality is that you didn't know what to expect. So you are all over the place, revenge mode, fear, greed, all the emotions are going to kick in. And it's all because you really didn't know what to expect. So take your methodology, backtest it. Now you know what to expect. And if you know that during that backtest, there were cases where you had 3 winners in a row, 5 losses in a row, and now you're trading live, and today you just got 3 losses in a row, well, it's not pleasant, but it's normal, because your backtest show that you got, worst case, 5 losses in a row. So there is nothing to be too worried about, there is nothing to be too upset about, it's just one of those days, that's it. So you keep cool, you keep calm, and that helps you to manage your emotions and do step 1 well, so you can do step 2 and step 3.
Okay, so number 1, get yourself educated. Learn about the product that you are going to invest in. So manage your emotion, that's number 1. Risk management, number 2. And number 3, go and look for a methodology that you're comfortable with, but most importantly, backtest it before you put it into execution.
Exactly.
Fantastic, Jose. I had a great conversation with you, and I'm going to continue my journey to look for other futures traders, professional futures traders, to help me to understand this product better. And hopefully I can be a good trader like Jose one day. Thank you very much, Jose.
Thank you so much.
Yeah,
Such
nice
a pleasure to be
today.
here.
Right.
Thank you so much.
Thank
And
you
guys are amazing. Thank you.